Well, thank you, Rick, and thank you, Hamish, for inviting me out here today. It's a great pleasure to be back at my alma mater. My happiest memories at Oxford are of doing a DPhil here and of being part of the Oxford University ballroom dancing team against the old nemesis of Cambridge. But it's great to be with you here today. As Rick mentioned, I work at McKinsey. I lead our ESG practice in Europe, Middle East, and Africa. And what I'd like to share with you today is what I'm calling 10 use cases of economics in sustainability and sustainable business. So I guess what I'm trying to convince you all of today, that all of the great academic content that you're studying today actually does have a use in business, you know, in the external world. And to start off with, I'm going to start with a piece of good news, which is we're all economists in this room. And recently, you may have seen in the press, there's been a report on different subjects that you study at university. And the good news is that you have chosen the right subject. That's the conclusion of this study. But essentially what it looked at is it said, on y-axis, what's my undergraduate degree's impact on the gross earnings of working age graduates? And on the y-axis, it said happiness. So the top right box here is where you're expecting an earnings increase and you're very happy. This is what we call the optimizers in the top right. And you'll see economics is firmly in this quadrant, along with a whole load of medical, pharmacological subjects. Of course, you could say, why didn't you choose Celtic studies? Because that's even higher on the happiness index. But you might have also chosen a subject in the regretful corner here, or the patient corner, the bottom right. But I was pleased to see that economics came out in the top right quadrant here, just to get us going. Now, the first thing I'd like to point out, and in discussing with Rick beforehand, is what do we mean by sustainability? And what we mean by sustainability is actually quite a broad canvas. There is the E of environment, which is everything from climate change and greenhouse gases, natural capital around biodiversity, carbon removals increasingly in the space, pollution and waste, and the notion of circularity and reuse, and then environmental opportunities in clean tech and so on. On the S is everything to do with people. So this is human capital, it's the impact of your product, it's the communities around your business, for example, around a mine site for a mining company. And it's also opportunities, for example, access to healthcare. All of this is underpinned by the G of governance, which is essentially just how do you organize as a company to deliver on E and S. G is an enabler of E and S rather than a good, you know, in itself. So this is the canvas that we have before us today. And what I'm going to share with you is what I'm calling 10 use cases. So 10 cases where something that I learned in economics, you know, has been of use, you know, in business. And these are very simple economic, you know, principles. You'll be sort of aghast at how simple they are, right? But they are very applicable. And 5 of them actually relate to the E of the environment. So the marginal abatement cost curve, the carbon, learning curves and path dependence, the green premium, in some cases the green discount, what we call tailwinds in sustainability and financial valuation, and then the question of measurement, e-liability, which has been developed in this university by Karthik Ramana and colleagues as a measure of carbon emissions, and then price bifurcation in markets. Under the S, we will touch on the social premium. You have the green premium, you also have a social premium. That's something that's been looked at again in this university by Jan de Neve at the Side Business School. And then we're going to come on to a set of factors which you can think about in the G, or even more broadly, you know, that relate to sustainability. So the first is you take the financial concept of value at risk and you augment it to what we call value at stake and playing offense. This is very tangible framework for senior business people. 8 is around Metcalfe's law and the power of networks and standards. There is a proliferation of standards and networks and regulations right now. Metcalfe's law, I think, is going to cut through that. We're going to talk about the policy cube, and it's not just standard pure economic theory policy. There's a lot of real developments, essentially, that came originally from the University of Chicago. And then we're going to talk about the end game. Multiple equilibria, good and bad outcomes.
And the royal family.
and the royal family, and the penguin on the bottom right. If you have questions as we go, just chip in, raise your hand. I think Rick is gonna triage any questions. So the background on E is a very ambitious global pathway for net zero emissions. Carbon emissions, then more broadly greenhouse gas emissions, which include methane and others. And you'll see it's an extraordinarily ambitious pathway that takes us to the Paris 1.5 degree objective, where carbon emissions come down by 2050 and are entirely effectively offset by carbon removals of tons of emissions from the atmosphere. And that's why it's so-called net zero, because any remaining emissions, for example, in industries like aviation, where at the moment there is not the technological pathway to gross zero, are offset by true carbon removals, not avoidance, but removals of tons of carbon from the atmosphere and geological storage of those removals. So it's a very ambitious pathway that the world is pursuing, but we have to pursue this pathway. And we as McKinsey have done a study on what does this take. The short story is it takes an enormous reallocation of capital. It takes something like $9 trillion per annum of so-called green capex between now and then, which is about 7.5% of global GDP. About a third of it is going to be new capex. You have not seen such a shift in capex and repurposing of capex since the Second World War. So this is a huge industrial transformation. Now, the good news, if you will, is that when we look at the technology solutions which are going to take you down that curve, around about 70% of those technology solutions exist today in some shape or form. They exist today in some shape or form. So in the power sector, offshore wind and onshore solar, photovoltaic, nuclear. Industrials is extremely important around hydrogen, low carbon, iron and steel, CCS, carbon capture and storage, and circular textiles. Transportation is another very important chunk of this. If you look at electric vehicles, e-trucks, whether that's going to be hydrogen or electric remains to be seen. Sustainable fuels, for example, sustainable aviation fuels. And then buildings is a hugely important segment here. Heat pumps and insulation, for example. And then agriculture and fertilizer. So through technologies which are known today, you can reach 70%. The remaining 30 will have to be new technologies which are developed between now and 2050 that could hit the market. And in the meantime, the objective is to scale these at an enormous level to come down that emissions curve. So the first catalytic object that I want to share here, the first use case, if you will, is what we call the MAC, which is the marginal abatement cost curve, which is, again, an extraordinarily simple application of economics, which is essentially an average cost curve. So what you have on the x-axis is the volume of tons abated. And on the y-axis, you have the cost of doing that, per ton. And you line up all the abatement levers along this curve. And what you find is on the left-hand side, there are a bunch of levers, for example, energy efficiency improvement, insulation of the home, which are in the money today. These are in the money today. And they're in some sense a free lunch, in the sense that they're NPV positive, because they reduce cost and they reduce carbon, in essence. And this is quite a substantial chunk of the curve, no matter which industry you look at, is the first chunk of the curve is around energy efficiency. And you might say as an economist, well, why is there a $20 bill on the street and why hasn't somebody picked it up? They just have not been tackled yet. A good chunk of the emissions reduction is in the money now. You then find a section of the curve volumetrically in the middle where you have a cost, between $0 and $100 a ton, which can be in the money depending on the carbon price. So if the price of carbon is say at 100, then changing heat sources, for example, towards electric heat sources, it's going to be in the money. By the way, some renewable electricity is actually on the left-hand side already. And then on the right-hand side, you have the challenging chunk of the curve, because this is the chunk of the curve which is not in the money, which is quite expensive. I mean, carbon capture and storage at the current cost point, is north of $400 a ton. We're going to see later that there's a price, by the way, that corresponds to that. But as a cost point, you come across, various biofuels-based solutions, for example, on the right-hand side of this. And this is challenging because we do need to get into this chunk of the curve if we're going to ride all the way down that net zero. But it's not NPV positive for an individual, company. So this abatement curve, we sort of produced it in every possible sector you can imagine, from aviation to pharma and so on. Yeah.
What interest rates should we use to calculate this net present value? Because it's a big issue.
I think we use a fairly standard, interest rate. I would have to check, but I would argue that it doesn't make that much difference, Rick, because most of these costs are quite front-loaded anyways. Mm-hmm. So the discounting of cost is most of these costs will be in the next 3 to 5 years anyway. So whether you use a discount rate of 7% to 10%, I don't think has made that much difference to where the block is, on the curve. But the utility of this approach is it enables you to say, right, where are the abatement opportunities in a given industry, like say aviation. So if you take aviation, on the left-hand side, you've got some sort of free lunch, if you will, for example, reducing stacking at airports for planes wanting to come in. And you have fuel efficiency. So a lot of planes waste fuel. So if you reduce that fuel wastage, you save money and you save carbon. But then you have sustainable aviation fuel, which is the big ticket solution for aviation. But that's 5 times the price point of jet kerosene, 5 times. And so that is on the right-hand side of this curve, $200 to $300. Yet the industry is committed to sustainable aviation fuels 10-20% by 2030. So this is the first use case that I wanted to share with you, and it helps you structure everything around decarbonization and greenhouse gas reduction. Now, the second use case I want to share with you is the learning curve and path dependence. Again, something which has sort of been developed and explored by economists. Because in those technologies that I talked about, you do, in some cases, see very strong learning effects on unit cost. If you look at this chart here, you look at the evolution of offshore winds, for example, which, a number of years ago, everyone was saying offshore wind is a transitional technology. It's never going to, make money at current market rates. The cost of that has come down about 70%. You look at the cost of essentially solar, and that's followed a similar path, and then battery storage as well, right? There are some technologies here which are the more conventionals around gas, which are relatively, and onshore wind, which have seen much more modest, changes here. But the good news, if you will, is that you've had something of a Moore's law on the key renewable technologies as you've driven down the learning curve. And what you see here is kind of chicken and egg economics, right? So when you're at the top of this curve, which you are now for sustainable aviation fuel, the unit cost of sustainable aviation fuel is very high now, $400 a ton abated, partly because there's very little volume and very few airlines are using it. If you can break that chicken and egg cycle, then you start to ride down these curves here. And you do see companies moving on this. So Air France, signed major offtake deals with Neste, which is the biggest supplier of sustainable aviation fuels. which is effectively giving you a 10-year forward demand curve. Think about it from an economics point of view, which then means I can build my capacity and benefit from economies of scale and then come down these curves. The second effect, which actually has some policy implications, has been documented by Philippe Aguillon and colleagues, which is path dependence. And essentially what they find is that companies where you've had a history of innovation on clean tech, they look at the automotive sector, so clean tech, electrification solutions, battery solutions, and so on, tend to innovate even more in the future. So there is a path dependence in the type of innovation. By the way, that's true also of the dirty knowledge, if you will. But what it means from a policy point of view is that if you have a shock in the price upwards, for example, carbon price, you make the clean innovation much more attractive. And there's effectively an argument for acting sooner on incentives, because you will trigger this path dependence, and the learning curve that you saw on the previous page. So from a policymaker point of view, from a pure economics lens, there is a case for acting sooner rather than later, so that you get to benefit, from these curves. Now, let's just unpack financial valuation for a moment. If you go to your finance classes, you will know the formula for the value of a business, the valuation of business, which is pretty conventional and straightforward, as the invested capital plus economic profits divided by the cost of capital minus the growth rate. And if you're going to unpick the drivers here, we're going to unpick economic profit, or the so-called operating margin, times by the capital base and a return, and we're going to unpick growth. We're going to unpick these two drivers of valuation just for a moment. And let's start with the operating margin or pricing, the green premium, so-called. So again, when I came to study economics, you get taught that there are certain markets which are commodities. The market for corn is a commodity, same price everywhere. And as part of that, I was certainly taught that markets like steel, aluminium, nickel are commodities. Not so, actually, as it turns out, not the case since the Green Revolution. So if you look at some of these markets, let's just take plastics. Many companies now, like Walmart, have said, if you're going to supply to Walmart, then you have to have recycled plastics. You can't have single-use plastics. You will not even be supplied to us. So you've seen effectively a recycled plastics product, which has a price premium of anywhere between 10 and 50% relative to the single-use plastic, if you will. And by the way, we're expecting that premium to increase in future because we're expecting the demand to go up, but the supply is still quite short. This is also true of green steel. Again, green steel, the automotive OEMs have all set out extremely ambitious Scope 3 carbon emissions targets, reducing emissions on their value chains. As a result, they have to buy green steel. And again, you are seeing a price premium here, anywhere 10, 25%. We could see that going up to 50%. So you're seeing this with a whole load of commodities. We were talking beforehand about the Lego brick, as a consumer example, or plant-based food. You are seeing green premia emerge in these markets, very simply because the demand is in excess of a short supply. And as that short supply unwinds, then these premium might come down, but that's actually a ways off because the supply is so short at this point in the market. And so what you're seeing from companies is innovation. You're seeing BASF selling, creating a product, ChemCycling, chemically recycled plastics, or Rio Tinto, the mining company, selling certified low carbon aluminium. So companies are sort of responding to this by developing products that are low carbon, low plastics products. Now, if we switch to the other bit of that valuation formula, which was G, growth, what you're also seeing here is the emergence of a whole bunch of effectively new companies which have come out of nowhere. Tesla is the best known one on the list, but there's plenty of them. If you take Northvolt in batteries, if you take H2 Green Steel, if you take Beyond Meat and Impossible Foods in the consumer space, or Oatly, many of you may enjoy Oatly milk. These companies essentially said there is an opportunity here, what we call a sustainability tailwind, to serve a new demand space, if you will, and to attack, the incumbents. And what you see in the numbers when we look at this is that companies which operate in these sustainability tailwinds, electric vehicles, for example, bio-based consumer products, generally trade at valuation multiples of around about 8 times companies who are facing the headwinds. So you're seeing a valuation premium from being on the right-hand side here, which is essentially because the market is expecting a higher G from these companies on the right. By the way, the companies on the left can be extremely profitable if you look at oil and gas, but they trade on a much lower multiple because the market is expecting their growth to be much lower in the future. Now, how do you measure all of this? Well, Karthik Ramana of the Valuation School has developed a methodology called e-liability, which is essentially to think about carbon as an item on the P&L. So you create a carbon liability, and you transfer that down the value chain exactly as you do a value-added tax. It gets transferred from one customer to the next down the value chain. And then on the asset side of the balance sheet, you have carbon removals, which are removals from the atmosphere of carbon. And so we could certainly see a scenario in future where every company has a financial set of accounts and then has carbon accounts. And you have a stock, which is the balance sheet, and then you have the flow, which you pass down as in the profit and loss account. So we could certainly see this emerging, as a way of measuring, the carbon emissions, which historically have been pretty intractable to measure. And what you're also seeing is a bifurcation in the market between avoidance offsets and removals offsets. So avoidance offsets are things like we pay money for a forest not to be knocked down in the Amazon, right? And there's a lot of discussion about whether that was really truly avoided deforestation, would that have happened or not, versus a technology-based removal where you do direct air capture of the carbon and then store it geologically for 10,000 years. So it's a non-trivial exercise. And you're seeing the market pricing these very differently. So the avoidance offsets are trading, $3, $10, $15 a ton. The true removals are trading anywhere north of $300 a ton. And this is, by the way, partly because the Science-Based Target Initiative, which is one of the key initiatives to validate targets on emissions, has very strict requirements on the use of offsets. So it's saying there's a limit to which you can use avoidance offsets, and we encourage the true removal of a ton of carbon from the atmosphere and geological storage. So the market is now reflecting this difference. And the right-hand side of the page is a pretty interesting side of the page, actually, from an investment perspective, because you've got a large demand curve in the future for true removals, offsets. So that's a little bit some of the use cases on the E side of it. I just want to touch on the S side of it briefly, which is there's quite a well-established literature that says that more purposeful companies have happier employees, more productive employees. What Jan de Neve has looked at the business school recently is, are those companies performing better? And is it correlation or causation? And what you do see is that the sort of the top 50 companies, in terms of measures of well-being, quite clearly outperform their peer group who have lower well-being, lower job satisfaction numbers, and effectively try and strip out the correlation versus causation by taking new samples of companies through time and looking at the subsequent change in financial performance. So I don't think they would claim that it completely uniquely identifies causality, but it's highly suggestive that if you're a CEO and you're thinking, do I invest time and bandwidth in building employee engagement, purpose in the organization, does it have a financial return? It's highly suggestive that there is a financial return from that kind of activity. And hence this is why we call it the social premium. We'll now switch a little bit gears to policy. So we talked a lot about the private sector and companies. What about the role of policy? We think about it in terms of a cube. So you have different industries: e-commerce, retail, consumer goods. You have different jurisdictions, regional, member state, EU, for example. And then you have different levers of environmental policy. You have measures on relative price, most obviously carbon prices and taxes. You have subsidies and tax breaks. You have mandates, and you have reporting rules and standards. And there may well be more, by the way. This may be an incomplete list, but these are some of the policy levers that you see the government's pursuing. And what I was saying, we were talking about this with Rick and Hamish beforehand, is the actual determination of policy to some extent depends on technical factors. So the classic would be Martin Weizmann's paper 1974, Prices versus Quantities, where he has a policymaker who is uncertain about the marginal damage cost of carbon. And then there's a variable theta, which then becomes visible later. And depending on the shape of that marginal damage curve, determines whether it's optimal to have carbon prices or quotas, in essence. So that's a kind of technical solution, and that's had an impact. But I would say the right-hand side of this page has also had quite a substantial impact, which is originally set out by George Stigler at Chicago in terms of the economic theory of regulation and capture, and then more recently by Richard Baldwin in terms of asymmetric lobbying, which is essentially saying that people who are going to be negatively impacted by a measure are more likely to be vocal than the people who are going to be positively impacted, if you sort of boil it down. Just as one local example that you may have seen, I don't know if anybody watches Clarkson's Farm. Does anyone want to watch Clarkson's Farm? No? One or two people watch Clarkson's Farm. But for those who, sorry? Admits to it. Admits. Yeah, okay, so who admits to it? But as those handful of you who have watched it, you would have seen that the Clarkson, who's developed a farm actually in Oxfordshire, very near to here, spent a couple of years essentially putting in planning applications to develop a restaurant, which was going to employ 50 people. It was going to use local produce. It was blocked first. Then he found a loophole, opened it for 2 months, and then it was shut down with an enforcement order. And essentially, you had a handful of people in that local community who did not appreciate the impact of this restaurant, and that essentially blocked it. All of the beneficiaries of that restaurant, the 50 employees, and then the thousands of consumers of it, were silent, effectively. And this is what you see a little bit in policy here. And one thing that's quite striking, if you look at the Inflation Reduction Act in the United States, it's $400 billion of funding through tax credits and grants for renewable technology. There is no carbon price. There is no carbon price. So it's an alternative package of measures. It's had a very substantial impact, by the way, on investment, attitudes in a positive way, I think we would argue. But it doesn't have a carbon price at all, right? And that's not explained by a Weizmann model. That's explained more by the models on the right-hand side of that page that I showed, I would argue. Again, at this university, because a lot of the great thinking originates from this university, as I hope is clear to you all, Miles Allen, the geologist, has developed what he calls the carbon take-back scheme, which is the notion, it's like a plastic bottle recycling. So if you have a plastic bottle, to get your deposit back, or a glass bottle, you need to return that glass bottle to get it back. And his idea is essentially to have the same thing for carbon. So if you emit a ton of carbon, you should remove a ton of carbon from the atmosphere. It doesn't have to be the same ton of carbon, but you should remove and store a ton. So one scenario you could see in future, this is a bit future gazing, is a carbon take-back scheme, which, if it were implemented, would essentially result in net zero emissions, if you think about it. We'll then move on to, how do we think about value? And Hamish asked us beforehand, okay, this is all fine, but does this in any way relate to profitability or financial performance? So I'm going to come to that now. From a finance point of view, you learn about the concept of value at risk, which is effectively the line at the bottom end of the normal distribution. below which, you have a certain probability of losses, if you will. We've extended that model to what we call value at stake, because a lot of the opportunities are actually positive, on the positive end of this curve, and the outcomes are positive. And the way we think about it from a sort of business point of view is what we call playing defense and playing offense. So playing defense, if you think about a financial projection, if you do nothing on sustainability as a company, nothing, there are risks. You could lose employees, talents. You really want to work for sustainable businesses. You could lose customers. You could have regulatory sanction. The first thing you can do is play defense, basic defense measures, carbon emissions reduction, HR policies. But it's the playing offense which is interesting, right? Which effectively is completely new products, as we saw, like Northvolt, plant-based food, growth and premium, like we saw that sustainability tailwinds page being on the right-hand side of that. The other thing, which is much less talked about, is actually green operations. Green operations, if you remove waste, lightweighting in your supply chain, you will have lower costs, right? So this is a pretty direct kind of benefit. And then you have talent attraction. When you add all that up, you get to a certain bar of profitability. So this is the chart from the MIT paper, where effectively what they find is that ESG improvements are followed by stock price improvements, and ESG downgrades, if you will, are followed by, again, pretty significant, financial negative stock price performance, right? Now, of course, correlation and causation, is it because the company is doing badly, or badly managed, or is it to do with ESG? But this is quite suggestive, I would say, that an improved ESG performance is going to be recognized by stock markets in a positive way, and that a deteriorating ESG performance is going to be recognized, with clout around the ears, if you will. And I think my interpretation of this is that the investors are interpreting these ESG measures, which are it's early days on these measures, that nobody would claim that anywhere near completely accurate. They're interpreting it as a signal of ESG performance and ESG commitment. So there is some early evidence, I would say, of that there is a relationship between doing good and doing well, as you say. So we talked about this, and then finally, in the last two use cases, I just wanted to talk about standards. So it's a bit like the old world of VHS and Betamax, where you had multiple standards running. This is multiplied to the nth degree in the world of ESG. If you take ESG ratings alone, like Sustainalytics and MSCI, there's more than 30 of those. If you take sector-specific guidance, there's more than 10 regional guidance. So there are more than 10 different kinds of climate pledge. There is a proliferation of climate standards, ESG standards, which is what you'd expect because you're in the early stage of a market, if you will. I think you can look at some of the network effects with an optimistic eye, if you will. So you start on the left with Sarnoff's law, which is effectively the power of a one-sided network is linear. So you add more participants, the network becomes stronger in a linear sense. You have Metcalfe's law, which is if you have two-sided networks, so like eBay in principle, or Facebook, when you have more people on both sides of the transaction, that effectively the power of that network expands as in the square of n. So more users. It's very, very difficult for another social network effectively to make much of an impact because you have a two-sided network, in Facebook. And then finally, Reed's law, which is around clusters of nodes, where again you have a sort of exponentially positive effect. You are starting to see some of these effects, I would say, in the ESG reporting space. So in particular, just need to press the button the right way around. In each of these areas, for example, when it comes to climate and targets, science-based targets is effectively becoming like a focal point. If you look at ratings, again, you're seeing a bit of a focal point around MSCI, Sustainalytics, and one or two others, out of 30. With standards and reporting, you're seeing the IFRS, so the international accounting bodies, stepping in, and that's going to have a massive impact. In terms of risk assessment, TCFD, Task Force Climate Disclosures, is now effectively mandatory for FTSE 100 companies. So you are seeing some consolidation, within the space, which is broadly good news if you believe you're getting to the right, VHS versus Betamax, the right sort of product, if you will. Finally, I wanted to just share a thought on multiple equilibrium. So you may have all, I'm sure you're all aware of the Diamond and Dybvig model. They just won the Nobel Prize for it, which was actually for bank runs. But one sort of basic insight you can take from Diamond and Dybvig is multiple equilibria are possible. That's obviously extremely well known from game theory. But that effectively in their model, you have a good equilibrium and a bad equilibrium. So one equilibrium is a bad equilibrium where everyone races to get their money out of the bank and then the bank collapses. And then you have another equilibrium where everyone keeps their money in, and you see a resurgence in the banks, and and you have a stable economy. And effectively, what the authors also ask is what would tip you to this good equilibrium rather than a bad equilibrium? By the way, do you know what the answer to that is in the last 30 years in practice? Anyone want to tell us? What moved the world from here to here?
Deposit insurance?
Yes, deposit insurance. So deposit insurance after essentially the 1940s, after you had the bank runs in the Great Depression and before, has largely, not completely, but to a significant extent, eliminated disequilibrium. Right? Not completely, but to a very significant extent, and moved you here. And so I think the analogous question for sustainability is you can certainly see an outcome where you have inaction, companies renege, countries, renege, but you can see a good equilibrium, like down here, where everyone commits, both the companies, the industry coalitions, and governments. And as economists, I think we can sort of help articulate what's going to move us from the top right equilibrium to the bottom right in terms of standards, commitments, focal points, and where we're going to land up in the good equilibrium. So on that happy note, Rick and Hamish, I will pause and see if there's any questions.
On this optimistic note, I think
okay.
Very much. Also thank people who ask questions. You still have a question that you can do afterwards?
Yeah, absolutely.
So thank you very much.